Perfect. So there's a lot of things we need to cover today because it has been quite a interesting weekend since the NFP, I would say. So that's Tuesday 1. So if you haven't been following my YouTube videos, you maybe don't know what I'm talking about, but there's a lot of things I'm very excited to for this webinar. A lot of impacting into the currencies, a lot of trading decisions right now. So basically what I'm trying to do is guide you guys through the latest insights. I've been reading some MUFG reports as well that it is quite helpful that I want to share with everyone in terms of me talking about what they say. And yeah, as we see here, there's a lot of things to cover, but I promise I will try to be very clear on everything. But yeah, the first thing is the tumultuous terrain, how the trade war is shaping the whole 2025, because we're on the second quarter already, and it's not changing. It looks like it's not changing, right? It's probably going to continue. The dollar under pressure is on. So because the U.S. sectionism is ending, most likely, then I'm going to try to cover from Asia to Europe, effects divergence and central bank responses, commodities, elections, geopolitics, and of course, much more beyond just the chart, because commodity has been going through lots of things. Anyway, so before we start, I need to put the risk disclaimer up as usual, and then we're good to go. All right, so let's take this off. Well, there's a lot of people joining us today. That's pretty good. Let me see if there is any new people today. Let me just zoom out. So it's Marjorie, Craig. Yeah, no, everyone here has been here, so that's good. Anyways, guys, grab a coffee, grab a notepad, and let's dive in straight in because, as I say, there's a lot to cover. Okay, cool. So, the whole thing right now is the trade war. That's what is shaping pretty much 2025. We begin that with what might be the defining feature of the whole year, the recognition of the global trade tensions. Usually tariffs back then, like I'm talking about 20 years, 30 years ago, they were just used to try to combat inflation into some sense, but now it's out of sense. We even got, I don't know if you guys have read my morning report today, but we even got now 100% tariffs on movies from Hollywood, from outside of Hollywood. Okay, so that's really, really not great, and just shows us how bad it's getting, because all of the this niche is the one that no one was expecting to have tariffs. Literally no one was expecting to have tariffs, and now we have it. So really surprising, really, really surprising. Anyways, I guess April was eventful. Reciprocal tariffs between U.S. and China, they climbed to levels that on stock, like reserved by dystopian economics textbooks, but we're talking about like up to 245% into certain goods, and that includes like a base 125% tariff, reciprocal tariff, plus fentanyl crisis tariff and section 301 layers. Think of it like a lasagna of protectionism, just less delicious and way more inflationary. The White House isn't holding back. The White House is literally going forward. And while there are rumors of negotiation signals being evaluated in Beijing, official official talks, they haven't resumed. So for now, the market is treating these like a potential Cold War over commerce. From Europe, things aren't calm either, because because Europe attempting to keep diplomatic cool, has offered to increase U.S. goods purchase by 50 billion. And it's a bit like, showing up to a boxing match with flowers, in my opinion. These tariffs, they have a 110% direct effect into the effects. And we are seeing those effects crossing a lot of high beta currencies. I guess if we look at gold, for instance, I've been telling everyone that gold would come back to these levels here. Oopsie, sorry. I've been telling everyone that gold would be coming back to these levels, and indeed we came back to these levels. Okay, and now we're pushing back up, most likely going for, again, all new highs. That's going to be really, really interesting. For those who have held the positions on Aussie CAD, let me go for like 15 minutes. It's better to see. I've got stopped out on this one. I've just tried to go into a new long, just this K-win, very small long position here, somewhere here. Where did I long that? Oh yeah, I longed it here. Along it here with his stop loss below these levels, most likely just got triggered stop loss, and then we'll probably revert up. But that's okay, because my main positions, as I showed this morning, is down here, and down here. So I'm really, really big on longs Aussie CAD. I was looking to target 90, somewhere around like here. I was looking to target 90, but maybe, just maybe, we're not coming there anymore. Looks like we had, like, on a 4-hour chart, this resistance, and that got touched it, and maybe we're coming back down. So for my, there's either two options that can possibly happen on Aussie CAD for those who are trading the same as me. Let me just grab the, no, it can be horizontal line, should be fine. Maybe we're coming back to this level of 89, okay, and then we're looking to revert to 90, just, break out back to here and then continuation up. Even maybe not even 90, maybe even like 91 or 9500, somewhere around those levels. Okay. So very interesting to see how that trade is developing. As I say, got stopped out on this small long, most likely coming back here. I will be longing again, but let's see how this goes. Cool. So the dollar is under pressure. Lots of people are looking at the GXY and see them like, oh, okay, it's pulling back. Man, come on. You really think that this is pulling back? It's literally nothing. Okay. Look at how much we dropped. All the way from 110 down to 100. Even below 98. And then we having like a 2% move up, and you think that's like, oh, okay, let's buy. I'm gonna be honest with you, it doesn't look like a long for me. It looks like much more like a correction, and then a continuation. Okay, continuation down, I mean. So between March and April, the DXY had lost 7.6%. And this is not because, oh, okay, dropped it. No, investors' confidence is pretty much going, like, it's dumping, it's eroding, because the fiscal policy looks increasingly erratic, and the scale of trade relation is triggering thoughts we've never used to entertain. Like, what if Trump does try to fire Paul, or he say he won't, but anyways, but what would happen? Or what if Trump is trying to orchestrate a weaker dollar? You know, there's all of those things, those things. So what I've been telling to myself is wait and don't panic, because I think that those sort of outcomes, they're very unlikely. You know, but when scenarios move from impossible to not unthinkable, that changes everything. That literally changes everything. Okay, so if you think about like foreign investors, they're holding nearly 18.5 trillion in US equities. A 5% reduction in that exposure means around 1 trillion in US dollars selling. Okay, so now imagine that happening as the US GDP contracts, as it did in the first quarter, as we saw that 25 in the first quarter of 25, I think was negative 0.3% or 0.8%, can't remember now, but it was negative. So that is, you know, that driven by a surge in pre-tariff imports. Okay, so very, very interesting how those things are going. Sorry, guys. Sorry again. I forgot to get out of my Teams. Too late now. Anyways, so the Fed, meanwhile, is trying to navigate like in the middle of the fog, you know, because think about, we have President Trump trying to do something, and then we have Fed trying to do another. They're not pretty, in my opinion, both of them are looking at the same side of the things. Yes, inflation, blah, blah, but they're not on the same way to resolve problems. And that's a problem. Okay. So I guess that from, you know, the Fed, they haven't touched the FFR, the Fed funds rate, since last year, and they're reducing the quantitative tightening pace. So rate cuts, of course, they are coming. You know, the people like big banks are expecting 3 cuts of 25 base points for this year, and that's the macro setup, and it's fulfilling further the US depreciation. And I think that it can possibly go like for maybe 80. You know, if we go to the daily, oops, sorry, 1 day, we can see that we're not far away from the 80. Okay. Oh, sorry, 90 right here. Okay. Because if we have that sort of move down, we're talking about a long on euro dollar. Okay, we're talking about a long on euro dollar. I guess my opinion here on euro dollar, I haven't longed that yet, just because I want to pull back at 1.12. So when it reaches 1.12, most likely I'm longing to go to 1.17. Okay. Oh, that's a daily chart. Sorry, guys. When that reaches 1.12, most likely I'm going to be looking to long until 117. Okay, until here. So something like that, maybe. But I will let everyone know. But for now, that's pretty much what I'm observing from the market. Okay, so again, and if that happens, then we have a stronger gold. We have a strong gold that is already going up since yesterday, pretty much. Well, let's say this week. This week we had. Let me just bring that out from my screen. Oh, and then get that tool. Okay, so from this week alone, Monday, Saturday, Monday here, we're talking about 4% up move already into gold. Okay. And this year we're talking pretty much about 25 to 30%. Yeah. And then Aussie dollar is a good trade as well, going long. consolidation, as the HSBC say. Break the consolidation, pulling back, most likely we're going to go up. I'm looking at Aussie CHF longs as well. Looking for a pullback at 52. Sorry, 53. So 0.53. So I have a long position there with take profit on 55. So let's see how that goes. My stop loss is on 52. So yeah, so just trying to catch that move up again. Let's see how it goes. Anyways, so as I say, lots of opportunities into the market. Now, let's go to Japan. All right, so the yen has strengthened somewhat last couple of weeks, last couple of days, sorry. And even have the drawing here, you know, when the market was here, I say, yeah, it's going to come back somewhere on that level and then pull back to 138. Cool. No surprise that it's happening. So the yen strengthened very notable, like in the whole month of April, you know, moving from, I think was 149, is it? Yeah, 149 all the way down to 139. But why? You know, that like one simple word will have, like, will answer that question: safe haven. Safe haven flows. Okay, so when the word starts to feel chaotic, Japanese yen tends to benefit. And if we look at the Japan 2-year yields, sorry, that's the 10-year, JP02. So when we look to the Japan 2-year yields, it fell very, very sharp in the month of April. Okay, like literally 0.80 to all the way down to 0.50. Okay, so we're looking at these and we're thinking, okay, that's really great for the currency, strong currency. But if we look to the US yields, completely different move. Oh, wow. What is this? What? Interesting. Anyways, so as I say, on the April here, we had much more sort of a consolidated move and not like a sharp decline as everyone was expecting. Okay, so really, really bad. Really, really bad. Anyway, the Bank of Japan isn't rushing into more rate hikes, but they are not completely out from hiking again. If I can't remember, but I think there's more two more hikes are expected by December this year, especially if inflation are looking, you know, to the upsides. In Europe, we had some sort of a good inflation pulling back, and then now we're looking to ECB much more, you know, stable. But for the Bank of Japan, a bit different. Markets is still holding pretty good for inflation, stable inflation, but we still need that punch up for the Bank of Japan to continue to rise interest rates. If that punch into inflation continues, we're going to be having US dollar Japanese yen all the way down to 138. Okay, that's simple as this. Cool. So now if we go to euro dollar, as I was saying, I'm waiting for 112. But anyways, you know, euro in overall had a very good month. It was one of the strongest 2-month performance since the start of the Q2 of this year, from 1.08 to 1.15, pretty much 1.15 against the dollar. And that's, you know, because of a lot of mixed of safe haven appeal, strong current account surplus, and of course, much more less erratic political backdrop. am not saying there is not political backdrop. There is still political backdrop in there in Europe, but we do have less than US in instance. Okay, that's one of the things that the market is looking the most at today's word, let's say. The ECB cut the rates by 25 base points in April, and they are expected to cut a further 75 base points this year. And if you ask me why, well, that's because the 20% reciprocal tariff from the US in looming for July. A lot of Europe officials know it will hit growth harder than the inflation. So what are they trying to do is they were trying to lower the interest rates ASAP, and on a timely manner that they want, like, destroy the economy and make it a very calm sort of progress. It's not shift. It's not the progress. The word. How can I say? Swift. I would say swift transactions. Yeah, swift transition. Yeah, that would be. So a smooth transition towards, from now to July, because July we're going to have tariffs on Europe, and therefore it won't be good, because that's going to be really, really bad for the growth, for the GDP of the country. Okay, and therefore what are they trying to do? They're trying to lower the rates as soon as possible, so then when the tariffs hits in July, they can still work around with the GDP. Okay, what would happen with the euro? That will have a lot to do with what the central bank is going to be doing until there. I still see euro dollar as a potential upside. Okay. Now, if I want to long euro dollar, yes, definitely, but not at this price. Okay, maybe waiting a little bit down the line. Okay, cool. So now to the Aussie dollar. Aussie dollar is, if we go for, let's say, Aussie CAD, just so we can have something. It's good, but it's bad at the same time. It's really interesting scenario here, because what do we got? We got a very fragile, even with the PMI, Albany's. For those who don't know, we had an election here in Australia. Okay. And the guy that was in power, he basically won again, and his name is Albanese. Okay. There's a lot of tariff uncertainty, and that's a bigger driver than the local politics at the moment. Australian dollar has underperformed since April, right? So the whole last month, it was very, very bad. And he's been the third worst G10 performer. The RBA is expected to cut rates by 25 base points in May, which that won't help. Okay, that literally won't help. China trade exposure and global risk aversion continue to weigh as well. So my take for Aussie dollar is short, but as I say, market was risk on, so I bought some Aussie. The Canadian dollar was suffering because of the oil prices were down. Therefore, I just literally try to do the best, that is chill and wait. That's pretty much it. Yeah, I think that's pretty much it for me into the Aussie CAD, into the Aussie dollar. There's not much helping Australian dollar, to be honest with everyone, unfortunately. Anyways, does anyone have any questions? I think it's all good until now, right? Cool. Okay, so let's go for commodities. Let's get back to gold. Wow, it certainly has been heavily long here. So commodities are reacting very, very fast and very, very heavily to trade friction. If we look to Brent, let's say WTY. Look at that. So it fell below $65 already. So it's trading at 57, 58, let's say 58. But it fell below 65 in April, but it could rebound. That could go a little bit up, all right? If the Middle East tension, especially in that Strait of Hormuz, they escalate, okay? I was reading a MAFTA report, and they are pointing out that oil choke points are becoming more volatile. So in Canada and Australia, as I say, we had an election here, um, and that election was interpreted as referendums on how closely countries want to align with or push back against the U.S. economic model. I follow 7 News or 9 News, I can't remember. I think it's 9 News quality. It's like a TV show, it's like a journal sort of thing in Australia. And I was looking at what Albanese was saying, that's the president of Australia. And it was kind of interesting because he say, look, I just had a chat with Donald Trump, a very good chat, a very warm chat, nice guy, blah, 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 blah. And then I saw another TV show he's saying that Trump talked to Australia Prime Minister. Yeah, he's good. That's it. So literally Trump doesn't care about us. So he's gonna definitely put some tariffs on us very, very soon. So that's gonna be very interesting to watch. Anyway, so China. Well, we had the Q1 GDP, was surprised to the upside. PMIs are dropping, container volumes to the US are plunging, and the People Bank of China is under pressure to try to put down the monetary policy. No stimulus yet, but it's most likely it will be coming. Okay, that's my opinion. It will most likely be coming. So let's finish with what everyone wants to know. How should we position right now? How can we go ahead on the markets? Well, I would say caution on US dollar longs. The dollar could continue to depreciate on that trend, as they say. Most likely it's a pullback. Unless the Fed pulls like a hawkish surprise this week, or whatever the tariffs suddenly disappear. Yeah, I mean, don't hold your breath because anything here is possible. But unless that US dollar remains very vulnerable, for me, I would prefer Japanese yen and euro as like a safe haven flows. There's much more structural shift in Japanese investments, as well as Europe. Current account surplus support from depreciation. But most likely we are expecting some bumps, down moves, that I would be looking to long. But yeah, that's pretty much from what I'm looking at. Japanese yen and euro, I think they're the best ones at the moment. Australian dollar and Chinese yuan remain very risky. As you say, it's a risky trade on Aussie CAD. China facing, currencies high volatility play. If you are bullish on trade, Chinese yuan and Australian dollar, that's fine, but make sure you're using a proper risk management. The short-term volatility looks like for me as opportunity. Like we expecting rate cuts from multiple central banks, and there's a lot of fragile labor data ahead. Macro FX trades, they will be especially sensitive to releases like the PMI, GDP, CPI, as of course the Fed this week. But most importantly, to stay flexible. Okay. The market in 2025, it's not the market from 2022. I've been saying this for months and months and in weeks and weeks already. So they are rewarding adaptation. So whether you're trading short-term momentum or building longer-term positioning, the key word is recalibrate yourself. Okay. So that's pretty much it from me. I guess we could cover all the topics, and then run down into the the commodities. I hope you guys have a lovely trade ahead. Have a lovely week of trade ahead. I'll be back tomorrow, same time, but we're going to be looking to trade together for the FinLogics too. But yeah, stay ahead, stay tuned, trade smart, think global, and I see you the next time. See you guys. Bye bye.